Hello, welcome to the Grow Your Wealthy Mindset podcast, where it is all about helping amazing physicians just like you create a wealthy life free from burnout and with the financial security to practice medicine on your own terms. I'm your host, Dr. Elisa Chiang. Good morning, good afternoon, or good evening, depending on when you're listening to this podcast episode. Thanks so much for being a listener of the Grow Your Wealthy Mindset podcast. I am sitting down to record this episode the day before I leave for Honduras for a mission trip. I'm really excited. I went to Honduras for this same mission trip back in 2019 before the COVID pandemic, and I haven't been on a mission trip since. So this will be my second mission trip. It's to the same location I went previously, and I had a fantastic time last time. I do oculoplastic surgeries. There is another ophthalmologist that does cataract surgery. And on this particular trip, I think there is also someone who will be doing strabismus surgery. So let's get into the episode. Today, I'm going to be talking about private lending as well as lending funds, which is a type of debt fund. On episode 104 of the Grow Your Wealthy Mindset podcast, I talked about investments specifically for what cash you have on hand, as well as investments for a short-term time horizon that minimize the risk of loss of capital. In that episode, I really deep dive more into high-yield savings accounts and money market accounts, CDs, and U.S. government bonds. All of these investments are backed by the full faith and credit of the U.S. government. The trade-off for these relatively safe investments, where you're pretty assured that you're not going to lose capital, is generally a lower return. Because interest rates are relatively high at this point of time, the rate of return is actually not so bad, but there are times where these type of investments can yield only 1% interest rate and be below the rate of inflation. There are two types of investments I did not talk about in that episode, which is what I'm going to talk about today. And that's private lending as well as debt funds, but more specifically, lending funds. Private lending basically refers to as funding from sources not defined as regulators as, quote, public lending institutions, end quote, which includes banks, mortgage companies, and credit card companies. A private lender is an individual or organization that loans money outside of the traditional financial services industry. You yourself can actually act as a private lender. Any individual can. And if you act as a private lender, you're making loans to individuals or other organizations with the expectation that they pay back the loan with interest. In a way, this is not so different than when you purchase a bond. A bond is an IOU. You're lending money to whoever issued the bond, and you expect to get the interest that the bond pays as well as the principal at some point. Most bonds will pay interest during the holding period, and the principal is paid at the end of the term. This differs from an amortized mortgage, where payments include some amount of principal as well as interest. With private lending, there is less regulation and government oversight than with bonds. I confess, I don't really know all the ins and outs of what's involved for a corporation to issue a bond. I've only owned corporate bonds from buying a bond mutual fund and have never actually purchased an individual corporate bond. I do have a little bit more, but still fairly limited experience when it comes to private lending. Most of my experience with private lending is in the world of real estate. When I started investing in real estate, the first money I actually made as a real estate investor was through flipping single-family houses. I purchased a bank-owned home that was unlivable and hired contractors to fix it up. I then sold it for a profit. Because the house was unlivable and needed a lot of work, I did get it at a huge bargain, but there was also no way to get a bank to actually give a loan on this type of property. Nor could I get money for renovation for this property. This is the case for many flippers. And flippers who do a lot of volume, well, they're going to need a lot of cash. When there's a need in the marketplace, often there is a way to make profit and someone's going to step in to fill that need in order to make profit off of filling that need. In this case, there are people called hard money lenders who will give loans to purchase and fix up a property to a real estate investor based on the business plan of what they're going to do with that property. The property is used for collateral for the loan, which is why it's called a hard money loan, because there's a hard asset backing the loan. These loans do tend to be high interest rates with short terms. Interest rates could be somewhere around even like 18, 20%. Terms may be 6 months, a year, or 2 years. These loans may also have points involved, so there are additional fees that are involved. It may sound crazy to borrow 18%, but if it allows you to get the job done and still make money, it can be worthwhile to pay that high interest rate for a short amount of time. I'm a little fuzzy about the numbers because I did this back in 2008, but at the time I bought my first investment property, it was for $33,000. It was a single family home, a 3-bedroom, 2-bath in a suburban neighborhood. I put in around $50,000 in rehab, and so I had roughly $83,000 into this property. Once the property was all fixed up, I sold it for somewhere around $120,000. So even after realtor fees and taxes, there was still good room for profit. And there was enough room to pay hard money interest rates and fees if I had chosen to go that route. I did borrow money in order to do this endeavor, but I did it through other means. That being said, I did talk to hard money lenders at the time I was doing this flipping in order to have a way to potentially have funds, especially if I decide to do multiple projects. The other option would be to refinance the house with the bank after the renovation and get something like a traditional 30-year fixed loan. With the refinancing, I would be paying off the hard money loan with the new loan at a much lower interest rate. In that scenario, I could keep the property, rent it out, and then get positive cash flow with no actual money even invested in the property because I was able to refinance and basically get everything out. Now, it's possible that depending on the numbers, when you refinance, you may not be able to get everything out, but ideally, you would completely pay off the hard money loan and no longer have any actually money in the property because that's what gives you infinite cash on cash return. That's what's called the BRRRR strategy, BRRR, buy, rehab, refinance, and rent. On second thought, it could be buy, rehab, rent, and refinance because you may actually want to get renters in before you refinance so that you can show the income when you are refinancing with the conventional loan. Anyway, you get the idea. I have met with multiple hard money lenders, and while some of them are loaning out their own money, there are others who actually will take investor money and they'll take money from other people who want to essentially loan their money out in this way, but don't have relationships with real estate investors, rehabbers, flippers, in order to have a source of people to loan to. So again, there'll be hard money lenders or private lenders who have investors give them money that they now loan out to real estate investors. So these hard money lenders act as a middleman to connect investors that have money with investors that need money. They can also analyze the property to make sure that it makes sense, that there's enough room between the purchase price of the property, the amount of rehab that's needed, and the after repair value of the property. They can also vet the real estate investor, the actual rehabber flipper, to make sure that they can actually carry out the business plan of buying the property, rehabbing it, and either refinancing or selling the property so that they can pay back the loan. So again, hard money lending means that the money loaned is backed by a hard asset, such as a piece of real estate. Private lending includes hard money lending, but not all private lending is backed by a hard asset. So you could have private lending that is not actually backed by something like real estate. An example of private lending that's not related to real estate is the company Doc2Doc Lending. For full disclosure, I have invested with Doc2Doc Lending and do hold an equity position with them. Doc2Doc Lending is a company that makes personal loans to physicians. Physicians tend to be a good credit risk, which is why physicians can actually get a physician mortgage with 0% down for their primary residence. If you recall back from physician training, or if you're not a physician, if you can imagine, there were probably times where you were really in need of access to money. When finishing medical school, many people have to relocate for the residency program, which means needing a security deposit as well as first month's rent on somewhere to live, money for the actual move, and so on, including even just food to eat. Since you won't get your first residency paycheck, usually until a month after you've started working, you might actually need 2 months of rent. Instead of putting everything on credit cards with high interest rates, if you don't have the savings to support all those expenses, Doc2Doc Lending offers loans to fourth-year medical students at a more reasonable interest rate than you would get from a credit card. In order to have money available to loan out, Doc2Doc Lending accepts money from investors where they pay an interest rate that is higher than what you would likely get with a high-yield savings account or CD, and then loans out this money at an even higher interest rate to the people borrowing money from them so that there's a spread so that they can still make money in that spread and keep their company viable and paid for the expenses of the company. But then their investors who loan them money make a good interest rate, and their clients who need money are paying a lesser interest rate than credit card rates without, an introductory 0% APR situation. Doc2Doc Lending gives loans to physicians in training, as well as those who have completed training, not just fourth-year medical students. Those applying to borrow money through Doc2Doc Lending still go through an application process, just like if they were borrowing money from a bank. But I believe it's a more friendly process than trying to get a personal loan from a traditional bank. Hopefully, you're seeing some patterns of why someone would borrow from a private lender instead of getting a traditional loan. Traditional loans generally take time to process and can involve a lengthy application process. And even after that application process, you may not qualify. They typically have higher standards in order to qualify for their loan. A typical home mortgage takes about 30 days to close on the loan, and sometimes can take longer if all the ducks don't line up in a row. There are many situations where people may not be able to get a conventional loan, either due to time constraints, their credit history, or due to the asset that is backing the loan, like a piece of property that is currently uninhabitable. With real estate, conventional loans will generally have a lower interest rate and longer term compared to private loans, which is advantageous when you're buying your primary residence, but may not meet the needs if you're purchasing an investment property. While conventional loans on real estate do fund based on the asset, which is why an appraisal is necessary, the creditworthiness of the individual is really taken into high consideration. Private lenders can fund loans quickly. Sometimes you can get money in less than 5 days. They will make the funding decision more based on the viability of the asset and whether the asset has enough inherent value to protect them against loss from default on the loan. That asset may be a hard asset like a piece of real estate, or in the case of Doc2Doc Lending, that asset is really the ability to practice medicine and the kind of people who become physicians. This being said, many private lenders do develop relationships with the people that they lend to in order to get repeat business and really develop trust that it's a back and forth relationship, and they'll continually make loans, get them paid, make new loans, get them paid. Now let's get into debt funds. In broad terms, a debt fund is an investment pool where the holdings comprised of fixed income investments. A debt fund may invest in short-term bonds or long-term bonds, money market instruments, or floating rate debt. Debt funds can be relatively low risk. You could buy a debt fund that only holds US government-backed debt. Or debt funds could have higher risk. It just depends on what holdings are in the debt fund. There are debt funds that invest in real estate, and these can be described as real estate lending funds. They may hold traditional mortgages, or they may hold the kind of mortgage that's created by a private lender or a hard money lender. Currently, these funds have returns ranging from 8 to 12% and are often backed by first lien positions on real estate. There are cases where maybe some loans are the second position, but basically, this means that you can get stock-like returns in an asset that has a low correlation with stocks, which makes for great diversification. One thing that differs from real estate lending funds from real estate equity funds is the tax treatment. Unlike real estate syndication funds, where you're actually holding equity in real estate, these funds hold debt positions, so there's no tax shelter through depreciation of property. You may receive a 1099 dividend tax form or a K-1 tax form for tax reporting. It depends on the fund. Many funds use a REIT structure, which means that they do qualify for the 199A deduction, meaning that you can get a tax deduction equal to 20% of your income from that fund. This means that if your marginal tax rate is 32%, then you would actually be taxed at a rate of 25.6% instead of 32% on the income from the fund. That's still higher than long-term capital gains tax, which is what makes these investments not exactly tax efficient. You also want to make sure that any lending fund that you invest in has a REIT structure so that you don't have to file tax returns in all the states that the fund lends in. If you have a self-directed retirement account, whether it's an IRA or 401k, that can be a great place to invest in these real estate lending funds. One example of a real estate lending fund, and don't take this as investing advice, I'm just going to give you a solid example so that you could actually even go to their website and look it up, is the DLP Capital Lending Fund. According to DLP's website, I'm just going to read it verbatim, quote, "The lending fund is a real estate-backed fund focusing on originating first-position loans to professional real estate operators. Through our lending strategy, we are providing capital to top-tier operators and builders to create, improve, and preserve affordable workforce housing while actively helping our sponsors scale their businesses and make an impact. This fund endeavors to produce attractive, risk-adjusted returns by making short-term bridge loans, generally 6 to 24 months. These loans are typically senior, secured, first position, non-owner occupied single-family and multifamily mortgages," end quote. So you can see how this lending fund really matches the features that I spoke about earlier. There are short-term loans from 6 months to 2 years. There are loans given out to real estate operators, and they take a first lien position. So basically, they are the first place mortgage on a hard asset, a piece of property, which is generally a single family or multifamily property. This fund is open only to accredited investors and pays monthly distributions on investments. They have a preferred return of 8% and a targeted annual return of 9 to 10%. According to the website, the minimum to invest is $200,000. DLP issues a 1099-DIV. Per the website, redemptions can be requested after 90 days, so this could be a viable short-term investment. That being said, their website didn't mention whether there was a lockup period and what length of time that is, or if the 90 days really represents the lockup period. Some lending funds have a lockup period that can range from months to years. After that lockup time, then you can request either a partial or full withdrawal of any funds that you've invested, and then it can take 30 to 90 days for you to actually get your money. So the redemption period could be the time it takes to get your money after the lockup period. Here on their website, they just say that the redemption period is 90 days. So it's unclear if the redemption period includes the lockup period. So if you invest, you could get your money back as soon as in 90 days, or which after the lockup period, which I didn't see on their website, then it would take 90 days for you to get your money back after you make the request. Of course, DLP is not the only company that offers real estate lending funds. There are many others. If you are interested in investing in a lending fund, you'll want to speak to someone representing that fund and make sure you fully understand the terms of the fund. Information you definitely want to find out include whatever the minimum investment is and the liquidity. Again, things like the lockup period and redemption period. Depending on what account you invest from, you may want to ask if they allow investments from self-directed IRAs or 401ks, and if there's any UBIT, which stands for unrelated business income tax. It's nice to know the size of the fund, how many loans are typically in the fund, and the typical size of each loan. You may ask about how many loans have been completed in the past and how many have defaulted. Other information to learn would be what projects the fund typically lends to, whether they stick with single-family housing, multifamily, commercial, industrial, retail. There are all sorts of different types of real estate available out there. I would ask if all the liens are first position or if they ever take a second position, because your money is much more secure with a first position lien. Depending on who you're talking to, you may actually ask them how much they personally invest in the fund, or how much money the employees of the company have invested into the fund. You want to know how long the fund's been around and how many borrowers have been repeat borrowers. Is the fund really investing in relationships with the real estate operators so that they're coming back and constantly doing more business? Another good thing to know would be what current interest rates are being charged to the borrowers, as well as potential points. And how does that compare to in the past? And then, of course, you'll want to know what the historical returns have been to investors, how often you'll receive distributions, and what fees are involved on your end of the investment. Ask about what tax form will be sent, if the fund is set up as a REIT, and if not, how many states you as an investor would need to file taxes in. This isn't an exhaustive list of everything you may want to know, but I think it's a good start. After all your questions are answered, if you're interested in investing, then you'll want to ask how you can invest and whether they're even taking new investors. Well, I hope that was really informative, and let me know if you have any additional questions about investing with private lending or private lending funds. I try to think about all the questions that I personally have and address those in this episode. While I have actually done some private lending, I have not actually invested with a private lending fund yet as of this time. I have thought about it, and I think I'd really like to do it out of a self-directed retirement account, but haven't pulled the trigger of actually doing so yet. Thank you so much for being a listener of the Grow Your Wealthy Mindset podcast, and have a great week. If you love this episode, I'd really appreciate if you could share it with your friends and colleagues. The more physicians gain financial literacy, the stronger position we are in to live our best lives. If you enjoyed this episode, I would love it if you could share it with your friends and colleagues. And now for the disclaimer. I am not a certified financial planner, accountant, or attorney, and nothing I say should be construed as professional investment, tax, or legal advice. This show is primarily for your education and entertainment. I am a physician, but I'm probably not your physician. So if you need any medical advice, please contact your own physician. Thank you.